what we're going to do today is take kind of a phase one approach to make sure that we're shored up our options understanding in looking at some tactics that are advanced simply because most people don't do them, as well as an understanding of, when to go into options, which options, why I select the options, and the strikes that I do, how implied volatility fits into that, and all of those things. I'm going to share that screen again. Where's the share screen? Okay, so question real quick is, when I share a screen, are they able to see me or just the screen?
No, just the screen.
Okay, so now it's doing some really crazy things. Is that happening to you?
Yeah, but it's just a low res view.
Yeah. Let me stop it and try to put it back in again. Okay, so stop that. And then I'm going to share. Go back over. See if we can do it without. There we go. Okay. So yeah, I do want to make a comment on Apple. This is the minute chart. I'm going to go to the daily. Obviously, this thing has been really, really lethargic these last two pops. So we had this cycle right here that went down, and I had drawn the boxes around this one, and then this one each time, and then this one here sunk back down, and this one sunk back down, and now we have this one again sunk back down. And if I'm not pulling up the Bollinger Bands or anything like that, but if you did and you saw comments on the site today, those are really, really tight. And you also see that the 8 and 21 are just right in line with each other. We are still, even with all of the angst, we are still healthily above the 50-day moving average. And so Apple is still in a buy mode. It's just that when you're in options, you don't have the luxury of waiting through this longer cycle that occurred here. When this breakout didn't happen in the macro market, it turned over. And then also, obviously, that allowed Apple to take advantage of that with the shorters. So you have the volume down here, obviously, is going downward. So it's downward volume. We finally have a net buy day coming out of that, since this little three prong day where you have a low, you have a higher low, but then you sunk back below that. I don't like these triangles. I like them when they're in reverse, and we saw that, I think, on DPW, or one of the ones, maybe it was Ebon that has that. But those I like to trade. But when you see this, I'm a little concerned. And when the macro markets didn't break out, obviously it allows the bears to kind of take advantage of that. And but that said, we have not come close to the reversal pivot that occurred down here. In fact, we probably are pretty close. I don't know if you all have this Fibonacci just on your systems. If you have IBKR, you do. And the yellow line right here that's now blue, when I go over it, that's the 50%. That is your Model T retracement that's happened. And oh, looky there, we've crossed 2 days. We flashed underneath it and bounced. So frankly, what we've got happening right now is nothing more than a Model T off of the initial move on a pullback. So that is not unhealthy. It's actually healthy. I know that doesn't do anything for people that are sitting in the Fed 19s, and I still have quite a few of the Fed 19s, because like I've told you, and like when these explode, when this explosion occurs, you're going to be able to cover a lot of earth very quickly and move this stock. So this move here would equate to a move up here about right at the 150 mark. So yes, We would like to push past 150. If you're in the 150 Feb 19s, you need that move to happen Monday, to start moving Monday. And even then, unless it's a really strong move, we're going to, really have to start thinking about making a transition. I know a lot of people already have, and that's great. But I know some people, including myself, even though I have some others, have the Feb 19s and maybe only the February 19s. So there's not a lot of time for us to deal with those. And if I take the option chain and I look at those February 19s, especially the 150s, I mean, they're right now, they're a lotto ticket. And that's just the bottom line. In fact, if you look at, go back and look at Apple, and you bring up the options, you can see, I mean, you want to spend another penny and lower your target by $2, you can. I mean, so it's literally that tight as you get this far away from the money with only a week to go. And that goes a long way to in terms of which strikes that we want to enter. If I were looking to enter Apple right now, obviously we would not be looking to enter a 150 call a week away. That would be suicidal to do that as a new strategy. So when you're looking at these, with the stock being at around the 136, 137, even that, I mean, you're paying for a premium. Actually, it's down here. So your cost is $1.87 if you wanted to try to go in the money. But the problem with that is that it moves in tandem with the stock. You might as well own the stock at this point. And so if I reached out here to March 5th, okay, when I say trading Monday, just think Tuesday because it is a holiday. So if I move out to March 5th and I look at even those 150s, your premium's 41 on that. So that would be a kind of a stretch now that the stock has dropped down. What I would do is I would be recalculating downward as well. So I would be looking out here somewhere in the 142 is a pretty good strike. And this is a March 5th. And so when you look over here, you get implied volatility is 28.49. The market sentiment drives option prices, and option prices drive IV, implied volatility. So you've got a 27.2 implied volatility on the options. On the stock, it's 28.49. And so the higher that number is, the more that stock is being anticipated to move. So some of the options you'll see are at 15, 16. Some that will trade, like I think IMMR right now, those are at 100 plus. And so those have a very anticipated move, a large move, and obviously we want it to be upward. But that just tells you the range over a period of time that those options are thought to be moving, the implied volatility on those stocks. So if I were looking to enter a new Apple call and I was wanting to be somewhat conservative and not go, my bank account, then these would be March 5th would be the ones that I would target, the 142s. Simply because we know that the 140 level has been a hard resistance area. And once that is broken, there would be an explosion move that would take these calls happening in the next 3 days of trading, Tuesday, Wednesday, Thursday. Then you would see probably a 100% ROI. And really, that's what we were looking for when we were in Apple, is a follow through of the markets from this point on this reversal. So we spotted this correctly, made some money on some shares because I entered shares on this. I entered the calls. They went up. and then they just stopped. And so this is going to happen from time to time on these, and the markets are paused. Now, something else that I want us to add into what we look for in the macro markets when we're entering options and or shares, but specifically options as well, and that is the skew. This skew here. Are they able to see me at all right now?
Not you, no.
Okay, only when I am not on here. Okay, that's fine. So on your trade IBKR, this is SKEW, and you would select the index. So the symbol is SKEW. You select the index because it'll give you, I think, another potential thing to put in there that won't print. If you're on TradeStation, it's $SKEW.X. And if you're on Thinkorswim, it's $SKEW. Okay, so what this is showing you is a market sentiment that is going on to where there's a thought process, obviously, that if everybody has already bought into the market, well, then there's no one else to buy shares. So stocks are going to go down because they're going to start taking out stops. And frankly, that's what was happening with Apple, because it was just in a consolidation mode. There was no buying, no buyers going on. The selling, you may have felt intense, but let's take a look. It barely moved. I mean, it only moved a couple of bucks down from those tops. So when you look at this chart here of the skew, this indicator, when it's way up high, your hedge funds are going to really start putting on major hedges. When it's below the 135, and especially down here at the 125 and below, this is a fantastic indicator that you always want to consider in terms of how much money you're willing to put in the market, how much you're willing to go unhedged, and how much you're going to hedge. Anything above 135, and the fund managers, the big hedge groups out there, they start adding layers of hedging. And you'll note that, I use this a lot, on days when I think the day that I said, you have 10 minutes or 15 minutes after the market closes to enter your hedges, was right here. So we had come down, we came back up in the market, and then we had this most recent consolidation move. And so when it starts getting up here at above 145, you probably should start getting concerned and start trimming and or exiting completely. If I look at a longer term view, here's back to May of 19. What you see, and by the way, you can overlay the SPX on this, and the SPX will be mirroring very closely the movements of this. Of the skew. Okay, so standard deviation. I mean, this is what's happening here. Is these hedge funds and a lot of people. I don't educate people on one standard deviation, two standard deviations. That's all confusing. And there's mathematics behind that you can learn to figure out, and you can look it up online and figure out how to get the 68% and all of that for the deviations. But the bottom line is 135 is the mean. Okay, above that, and you're starting to get into a hedge. Well, obviously, we're all looking for a rally coming into next week. So that's going to push this back up into these ranges. So when we see the skew get above that 145, we're going to start trimming. We're going to look at our options trades that we're in, and we're going to say, if they haven't moved, then I'm now contemplating, are they going to move? So obviously we want to be patient with our options trades, but we also want to be cognizant and mindful of the skew. Because hedge, people that are a lot smarter than I am, and are in control of a whole lot more money than I do, they're paying attention to this. And so since they're paying attention to it and they actually trade off of it strategically, they make their plans, we would be wise to do the same. So above 145, that's when you'll see, I kept saying we were that last big correction. We had the dots. I don't know if you could see those dots right there, but we had these 3 dots right here where the market went to a new high and then came back down. And that's indicated here on the skew. I was adding to those hedges very, very large. In fact, I just kept saying every time we hit a new high, I'm going to add more hedges. And so that paid off handsomely because it allowed me I did take some here, and then we failed because that's Model T, by the way, is right in through here from there to where we ended up. So we went to the Model T off of this move, but then we fell all the way back down into a factor that was like almost a 25% move. So from a 50 Model T down to a 25 number on that Fibonacci is where we ended up. And so I was taking off a lot of the hedges along the way. We kept dropping, and then started doing a little bit of buying, but I didn't buy a whole bunch on this move, frankly, because of where we are in the market. So now with this pullback, I'm the same principle. We dropped below this 135. If you see this, we V'd off of that. We are now heading back up. So that tells you that even though the risk is higher, and you keep hearing that there's a lot of risk in this market, well, there is. But the markets right now, until they tell us differently, we continue to take money, but we just add hedges. So we ended up really high today. We didn't end up real high. We ended up going upward today. And so since we closed near a high, I went ahead and added some new hedges. And what I did is the SPY 350s out to April. Let's see. 200-day moving average is the key line in the sand. Yes. So the 200-day moving average is, yes, very good point right here.
This one here.
Yep, it's kind of a line in the sand. That's a very good point. And if you'll notice, when we drop below it, if it can accelerate, if it's going to be a major correction, a little bit longer correction, and if it's not, then it'll jump back up. Now we got to be careful with this. It has come back, and it looks like we're moving above in territory that the hedge funds are starting to add. And you got to think inversely when you're looking at this, because, well, isn't this good? We're heading up. No, it means that from the hedge fund managers, they're going to start adding the hedges on there. They're going to start putting more hedge on there. Also, what happens is this impacts your implied volatility, because the higher the risk, the higher the volatility on the options. So volatility is good for options. That's how we make our money. Is we want to see a lot of volatility in the markets, as long as it's moving the way we want it to move. It's when it moves the way we don't want that volatility also can really hurt you. And that leads to, a question that someone asked yesterday was, why not buy, I can't remember what stock it was at $15. Why not? Oh, it was IMMR. So why not buy a $15 call instead of a March 19th call, instead of let's just go to it. So we're going to go to March, and the $15 you'll see that, we're pretty tight here on the premium, and we get pretty wide here at the 15s. So the ones that are, at the money, and you'll see also, quite a range on those. That's an 8-hour candle. Let me get down to a daily so we can see that. Okay. So this is, there we go. So today's range up here $2.45 to $2. And so what will happen is if this stock really took a drop, these are going to have a major move down, whereas your out of the money calls that are that far out are going to have a much less impact. Also, when this starts to go up, your percentage gain as a percent of the stock movement upward is going to be more compressed than a out of the money call that is getting approached. And that's just a natural IV response to how the implied volatility impacts the options. And so if I look at IMMR, we had it's wedging after its move up. Well, that's the end of the day. Let's go to here. So yeah, same. It's wedging after the move up here. We've had some resistance right here, but we're above that. And if you draw your lines, you're going to see that your resistance that was broken is now becoming support. And so I like to see this where you have the support that's following the 8-day moving average. And basically it's biding its time until we have the breakout move. And because we're so far out to March 19th, we have a lot of time. And that's kind of the beauty of having options that are, 85 cents, 80 cents to 95 cents, somewhere in that range, is that the deterioration factor is going to be much slower while we're waiting on those. So let me get back. I want to go back to skew. Does everyone understand what we're looking at on the skew? Add in your comments down there.
Here's a question for
you. Okay. You necessarily target a certain delta amount, or are you just targeting the strike price that the chart suggests? I will pay attention to deltas when, and with IBKR, you have the ability to use the strategy builder, and you can look at, all of the various components of that. But I will say that while I look at delta, my main consideration is going to be trend. Trend, volume, insider purchase, the volume lot size that you can see on stocks when they're being bought. This is, if you look at this is a more thinly traded stock, so it doesn't take a lot of volume to really get it moving. And it's one of the few, frankly, that is under 3 million a day volume that I'll do a call in. So yeah, you did, Brian. We entered but you're going to get a dime bonus for doing that, for missing class. So as long as it doesn't pop first thing Monday or Tuesday, yeah, we're in the March 19th $20 IMMR calls. Yeah, there you go. Hadn't moved much yet. Yeah, right. I mean, we're in a consolidation.
Talk about one above it.
Skew measures price difference between equidistant calls and puts. Yes. Which one is more expensive? I.e., which one's more expensive? Yes. So yeah, that's what your skew is doing. Is it's basically monitoring where the hedges are being put on by the large fund managers, by the biggest of the big out there. And so it's something that we don't want to ever take for granted. And we always want to keep a reference. I'll look at that every day. So I'll just take a look, and usually I'm looking at it at the close of a day. So because, what's happening during the day, you're feeling and you're seeing. But at the end of the day, I want to look and I want to see, do we have this pattern, this little triangle pattern going? Because to me, again, I don't like to see these. I like to see these because as you see, even though this one's further apart, it led to that's a chart pattern that you're using on skew. Even though it's not meant to be used, it finds its way into being very useful on the skew chart. So now we have this triangle that's happened. and we're moving back up. And isn't that interesting that you'll see this, you'll see these patterns that the markets give you. Here's one here that led to that one. Here's this one here that leads to this one. And so you got to think of the markets as, it's sprinters. You can't, and I think John Carter gave this analogy. And if you don't know John Carter, you should get to know John Carter. He's got videos all over the place. IBKR even has a John Carter attachment that you can do to your IBKR, and you can do all of his studies to show, but you only want to do them once you know what they are. But he made the analogy of you don't ask a sprinter to run a 200-yard dash and then go get back on the post and run it again. And that's how the markets are. The markets will sprint and then they'll sit and recover and rest, and that's consolidation. And consolidation can lead to turning over. Yes, it can. But regardless of whether it's leading to consolidation, the key is you want to be in the market when it's sprinting. And generally those movements are going to be anywhere on breakouts, from 8 to 12 days is what you'll get. 1, 2, 3, 4, 5, 6, 7, 8. You'll get anywhere from 8 to 12 on a macro move that's happening. You're going to see 8 to 12 days in general. So you can't put that as gospel, but you certainly can say, if I'm not a greedy guy and I'm looking to take the meat out of the markets, then I'm going to be starting my trimming at 6 to 7 days. And then as I'm getting further and further into that run that's happening, and yes, if you get into a squeeze situation, you could miss quite a bit, but you can always recalibrate. If you recognize a squeeze is happening, you can always recalibrate. Like right here. I mean, this right here was a classic squeeze that occurred after the macro bottom here, and we talked about it. And then this one here. So I think we drew charts showing the fact that when you have a macro breakout, generally you're not looking to enter your hedges, you're looking to capitalize on that macro breakout. So when this V confirmed, we're looking for a run. When this V gets broken to the upside, let me get closer. When this broke out, even though it came back, that's when you start loading. So if you weren't in the markets, if you didn't catch the start of the V, you had this gap right here close. We didn't even talk a lot about gaps on the first seminar, and the reason why we didn't is because all of the gaps got filled. The only gap that we have now is this most recent one right here on SPY. So on SPX, we have a very small one that's in line with the SPY gap, and then if we look back, we don't have anything until all the way back down here, which would be frankly a disastrous correction that's going on, a major correction event that would be going on. And even that would be above the 200-day moving average. So is it possible? Yes, at some point, something like this gap getting filled is possible. And as we look backwards, we'll find out that, in fact, every single gap leading up to that has been filled. That gap filled. This gap down got filled. So every single gap that was there, we have one right here, and then we have one right here. So when you get a V correction recovery, they like to leave you in the dust, so to speak, right? We talked about that, where they don't want anyone joining them down there. So if you didn't get in here, you're going to be chasing the market because that gap shows a lot of strength. And then you had another gap. Was it? Somewhere in here. Yeah, right in here. You had this gap. And again, it didn't get filled. And that just showed strength of market when you didn't get any type of a Model T off of the second gap. There's a lot of strength in the market. Now, you did get one from here to here. If I use the Model T, you got one, okay? But you didn't here. So the strength of the market off that V was known. Same here. Once broken, We didn't have, we had this gap right here that went really up hard, and then it fell back down and consolidated above the move. And when it crossed in and shut the gap, that's where I would look to be opening after a V. When you see a V, if you get a gap fill, that's a natural place for you to take on risk. I add risk, a whole lot of risk, when I see this pattern off of a hard V recovery. If you get a gap and then a return, what happens is this becomes support. We talk about it a lot. Resistance, once broken, becomes support. So now this line that we had is going to become support when it got broken, which it got broken right here. So it breaks, it comes down. Anything below, you are buying, you're being aggressive, and you're looking for that to come back and sustain. And then as soon as it confirms, you know, you can either add or you can start trimming. But these V recoveries, you know, we had this one here again. So we broke out, and that's why you don't hear me sending off flares, even though everyone and their dog is talking about the fact that the markets are, you know, they say they're overbought. They say that that the risk is high. But for right now, with this market broken, and you have this trend line right here, and we have not, all we did is came back and frankly have confirmed the support. So these days that you were down here, you know, we were entering. The last couple of days we entered IMMR, we entered SPWR, we've entered some calls, but I've also entered a lot of shares. We talk about DPW, EBON. We were going into these crypto stocks because of the narrative of the story, and crypto is, you know, it's going up in price, so it's just going to help our cause. And I expect to see a major run in those holdings, those offerings here in the not too distant future, maybe as early as Tuesday, because the price is just driving those. And there's a lot of interest, and frankly, the chart setups look really, really solid on those. So if I'm going in, you know, I did a lot of EBON. We're going to get into options, back into options talk now, but it's all intertwined, right? I mean, if you see the V and you see the confirmation of the resistance has now come support in the macro market, well, then that's when you want to be buying your options. So there's 3 times in my estimation where we want to buy options. We want to buy them at a support, major support level. Okay. We want to buy them off of a wedge support consolidation, the waves that are occurring, and we want to buy them on a breakout. So those are the main 3 that I will look for when I'm trying to scan and look. And then of course I'm looking at the volumes and all of those. So if I'm looking at EBON, this is a pretty good close, and it's gone on up a little bit, it looks like, maybe. But yeah, 675, this is coming above this resistance level that had formed here. And then the wedge, you know, we had the wedge come back. Model T, right? You guys, Model T, you use your Fibonacci, I'm sure, to get that in and know when you're going to add to your position. So this is when you would have been adding at the Model T. And it just happened to be beautiful for us.
It's a connection loss.
Where did I lose a connection?
That was that software telling you that.
Market data connection reestablished.
Well, that's wonderful. All right, so when we're looking at these, I want to make the case one more time. Model T, right? Let's do it.
Market data connection loss.
Oh, be quiet. Okay. Gold line.
Data
now
reestablished.
Right there. Now the blue line. There's your Model T. Okay. And it flashed below that, and I was buying a lot of shares. And I posted yesterday. I'm adding. I'm buying. The chart looks good. Same with DPW. all I could do is tell you what I'm doing. And I told you what I was doing in real time. And the reason I was doing it is because of that Model T, as well as the macro narrative that's going on, and the fact that we had a cup, and this is now forming a handle, which a lot of times the handles come back to Model T. The lower end of a handle that is forming will come back to Model T a lot of times. And so all of that, in my estimation, and in looking at the number of shares, the block trades that were happening, and then also the options that were being bought into the down movement, it was very heavy, about 2.6 to 1 calls to puts on the ratio. So that is what you're looking at and looking for. And so, yes, I was doing a lot of that, but I also buying a lot of the calls. And so I went out to the March, and I went with the 10s on the $1.35s. And then I did something that I normally don't do, but I did. And that is, those cost you 90 cents at the time that I entered them. And I exited them at $1.30. And at the same time, I turned right back around and I sold covered calls on 25% of all of that volume buying that I did around Model T. And so I took the gains on the options because I'm so heavy in shares. Why would I, add another layer of risk on top of that now that I've profited? So I went ahead and took those off. And then I actually came out also to April, and I added some 1250 covered calls at $1.20. And so I use a lot of covered calls when I have a major exposure in shares. I'll use a lot of covered calls. And what will happen is, let's say EBON starts moving up through in February. If it starts moving upward and reclaiming this $9 mark, well, the options, and just like what we're seeing in IMMR, for example, or any of your options that you have, if they're out of the money, you're going to start getting a movement on those, but you can decide at any given time to re-enter options, to cover, to buy back the options and raise your next option level. Because if my goal was to capture $1.20 at a 1250 strike price, and I can get a $15 covered call for that same $1.20 when the stock's at 10, why wouldn't I do that? You guys see what I'm saying? Does that make sense? So you should be buying once it comes back to Model T, 50%. That's where I've gotten wrapped around the axle. It went to enter a trade on the Model T. Yes, a stock that is trending upward, then you will use the Model T to make your entries. Okay. So on consolidation waves, if you missed a breakout and didn't get in, and you're waiting for unless it just runs off on you. And fortunately, none of these stocks ran off. I don't think DPW. I think its chart. That's not the right one. DPW. Okay, same, right? Not a lot of movement there. If I took the Fibonacci mark from where it started its move upward and drew it, you're going to get somewhere right here. Model T is going to happen again. And so, yes, to answer your question,
market data connection reestablished.
Is when they lose that, they're losing their sound. Can you all hear me now? Someone say yes or no. Okay, type in there. Okay. Can they hear me, or did something happen?
Okay, sounds good. Yes.
Market data connection lost.
Okay. Never lost you. Okay.
So that's just your software.
Market data connection reestablished.
Yeah, I don't know what's happening with that.
The
Yeah,
British guy's feeling me.
we're dropping electricity, and the backup is kicking in, guys. I almost rescheduled this. We're going to have another one because I lost a lot of my data, and so I want to get charged. I'm going to send you the content before we have the next call, simply so you can study it and then you can ask questions about it on the next seminar, because I really need my I need my data to be sharing with you. And being out yesterday due to this freeze, and here I lost power, and the backup, when it kicks in, it still loses everything, and because of the delay in kicking on, and so need to add a battery to that backup. So anyway, yes, to answer your question, and frankly, if we don't get anything else, Model T is a time to, on a trending upward stock, is a time to buy. It's your first inclination to buy. Now, when we're trading a wedge, like an SDC, and we entered the options on that multiple times, when we were trading these wedges that were occurring, and some of these were quick pops, and we were quick to take our money, because I think all of them gave 100% plus ROI. And really, what else could we ask for? But what happened on this wedge? It went to Model T and then died. It didn't continue on. And if you're looking back, and this is why I'm saying, take a look at the macro picture. You have a very slow upward channel. All right. So if I'm going to be entering options on SDC, number one, you better be right on your entry, because if you're wrong on your entry, it's not a long, even 11 to 15. If you get it right, that's great. If you're trying to play catch up and it's already run away from you, and you're thinking, well, there was a breakout day, and then you buy, the channel is saying that's not the case. The channel is saying you better be mindful that right now the bulls are in a very controlled upward trend on this. And that's why I traded the wedges, because every time, our first one that we did was this one, okay? And we went ahead and ran it. We got our money back, and then we stayed in, and we got a really nice payoff on it, upwards of 250, 300%. And then we traded this wedge right here. And then there's a third one somewhere that we had traded. I can't remember which one that was, but each of these drop below here is why I was buying, okay? Because I had the trend lines drawn. So my Model T wasn't so much my entering factor, right? What was it? It was the bottom of the wedge that I'm looking for on the trend line. And when that got violated, and then I start paying attention to the 200-day moving averages right here, and it violated. This is the day that we bought at the open, became the TM, the Trixie move, right? It was a classic Trixie move that happened, and we played them on this move because of the 200-day moving average. I was sitting on it, which is why we all got in early that day, is because I saw the move happen. It was an absolute perfect setup on the trend lines with the 200-day moving average flash and dash. And so this is, my three things that I like to trade, I told you, are major support. Well, the major support is either going to be Model T if I'm trending upward. So if I take a stock that has been trending upward, then I'm going to trade the Model T for any potential entries on stocks that I really like. If it is a sideways, slow channel, then I'm going to trade the wedges at support. Okay, so I'm trading wedges at support with my options. And so I didn't even buy shares. I mean, usually I would buy shares on this this classic move here, I generally would have bought shares somewhere into the close, but I bought a lot of options, so I just let it roll, and we went that direction. Okay, so and since the waves, and this is what comes into your first clue in terms of, okay, what is my strike price going to be? Okay, so how far out and what are my strike prices? Well, if we look at each of these wave channels, we had 1, 2, 3, 4, 5, 6 days. It topped out at 6 and did a quick reversal. Okay, and then this one was a little bit longer, I think. So it reversed again below and above. So 1, 2, 3, pause, right? 4, 5, 6, 7, 8, 9, 10. So if we drew a mid-range line on here, it kind of becomes a sideways Model T. And when you're pressing up above that, then that's when you at least need to start thinking of trimming those entries, because when it reverses, it's generally a hard reversal on channels. When you got these channels and they're pretty tight, the reversals can be very quick, and you'll see they just drop really hard and fast. This one did turn over slower, so if you were asleep at the wheel, you probably were able to get out with some pretty good profit still. But in general, these channel waves, they'll bite you really quick once they've topped out. So when I'm buying your options, you're thinking, okay, I want to have the best premium, and sometimes it takes 2 or 3 days. If I'm violated here and I didn't see the Trixie move, but I still bought some SDC calls. I just didn't say anything into the forum, okay? Because to me, this was a pretty high risk until it proved itself. So I was starting to buy some calls here, and it took 2-3 days for it to make its reversal. And I bought out, not knowing for sure just how far down. We bought out 30 days. And so I will always almost, go 30 days up to 6 weeks on my options, with a rare further, like we have with IMMR, out to March 19th. So it's going to be in that range, but it's going to be 30 days. And again, I didn't look at Delta. I didn't look at Theta. I didn't look at anything except that. That's what I looked at. So if you're going on to videos online and looking at all these great traders that are out there, and they get so bogged down in technicals with you, and they're showing you all of these formulas and everything else, I'm telling you, this is how I trade. And the reason I trade this way is because it works. And you don't have to be a rocket scientist to make it work for you. Okay? You will win trading this way. Now, we got a Model T on SDC. And remember, I don't know if those that saw me, I was saying, I would like to see a down day to enter. Well, we got the down day, but it stopped here, and it didn't make it past the 50-day moving average. And so that would have been a Model T. You could say, well, Randy, you said buy it when it's trending upwards, that you buy the Model T. Well, when I've got a tight channel, I'm only going to buy when I get down at the lower part of the channel, because you get a lot of pausing a lot of times midstream before, right here, midstream. And it sure looked good here. And then it just crashed and made it to the rest of the channel. So unless you're literally glued eyes to the screen and you're ready to do something and you make the right call to do it, this is very tight to be able to trade this, successful. This is a day trader, maybe, is looking at stuff like that. But what I'm looking for is these. I want this entry, that entry, that entry, this entry, and this line. If you drew this out and I pulled the full chart, it continues on. But this channel right here has become very defined. And so when you pull up your stocks that you're looking at, pay attention, draw channel lines and figure out where they are. And then, if you say, well, it seems like every time I buy, it goes down. Well, then buy when it's at the base of these channels. Don't even trade anything else. Just trade base of channels, because your odds then are at least at the highest potential of being right. Okay. Whereas if I'm buying here, now if the markets rally, it's probably going to be a midline bounce that's going to occur, and that's awesome. But I'm not willing to trade that on this channel. I want a perfect entry for SDC, or else I'm not going to enter it. Okay, so and what I'm going through here is, you know, decision making for entering trades. So you know why we did Apple, right? I mean, everyone knows why we did Apple. Everybody's like, don't bring up Apple chart again. I'm going to bring it up again. Okay, everyone knows why we brought, you know, why we're in Apple is because of the bullish harami, and the bullish harami confirmed. And the bullish harami is gave on shares. If you bought shares and options, then guess what? You're still, you know, you were pretty happy because you did some trimming up through here, and so you're doing okay. If you went options only, well then yeah, you're sitting there going, is this thing ever going to move? So that's that decision making process. But again, I think it's going to take off. I'm extremely confident you're going to see Apple absolutely launch and create, and it'd probably be a gap. If you got futures obviously open to the positive side on Tuesday, then you're going to see a gap. For those of you that ask, and some of you have asked me, what is the percentage on holidays? And I've given you percentages over the years. After this coming Monday, the average is like 71%, and it happens to be the third lowest percentage of an up day. But that also tells you that all of the other holidays, the next day after that holiday is generally an up day. Odds are we're going to have an up Tuesday. And so even at 70, you know, even above 70%, that's pretty good odds. And if we are, then you'll probably see Apple gap. And we still need to see this broken. Obviously, the first clue is going to be if this day gets broken. So when you see 136.39 get broken, then you're probably going to start salivating a little bit. But when this gets broken, that's when you start really getting excited, because it's going to be a very significant move. Okay, let's see. 3 things are using Model T on stock trending up, stock and channel use wedges, and it hitting bottom of channel. And third was how to select strike expiration. Okay, so you're not too clear on the third one, and that's because I don't have my charts to show you how I select my strike prices. So, and that's why we're going to have another seminar on options. Yes, you are. Because I'm trying to give you a picture here of just the thought process that I'm going. What else am I wanting to talk about here in terms of just, okay, so when to go leaps. Obviously, we made an absolute killing on AMC. And AMC then became a Reddit stock, so we all got really lucky on that. So I you know, wonderful. So if you were in options, if you were in those options, advanced strategies, and I gave it to you, but I just want to reiterate it. Use the markets that are given and trade the shares against your options when you're given those opportunities. That morning that AMC was pre-market above $25, if you were not shorting against 100% of your leaps or any options that you happen to be in, then you made a tactical error, and it's okay, just learn from it. But you have got to be able to sell short against your call options, and you've got to be able to buy long against your put options that go way into the money. So during a correction, if you have picked up some SPY puts and you layered on because of the skew was at above that 140 mark, 145, and let's say you had that triangle that we talked about, well, you may come with a 3 to 5 day put, I'll call it a put chaser. You've got your puts out to, right now, I'm doing April 19th, right? So I'm off of the March 19th. I'm on the April 19th. I don't have a whole lot of them right now, simply because the markets are not saying to have them. But I do have some, but I don't have a lot. Now, if we hit a new high, you'll see me start layering those hedges on there. And if we get to that 140 plus, then you'll see me start looking at a very hard rally day. I'm going to start looking at a 3 to 5 day hedge on the SPY. Well, sometimes you'll get a false flag. And if I entered a 390 hedge, let's say, and the markets drop down, so I'm sitting here at SPY, let me go to SPY, and I'm looking out here. Let's get back over here. Okay, let's say I wouldn't do the 16th, right? That's Tuesday, and you get day-to-day back days because of the holiday. So this would only be 2 trading days. So I'm going to go out here 7 days to the 19th is what I would look for. And so the market's at 393. Then I'm going to come out at least 3 days. But because of the way this is working, I don't like coming out of here because 2 things: the percentages tell me that the odds are we go upward on Tuesday. So I'm playing the odds is what I'm doing. And I'm going to count on that. But if we have a hard rally on Tuesday, if we break to a new high, I would start layering in my April hedges. I probably wouldn't do these February 19th yet. But if on Tuesday we did, then I would start eyeing something. Let's say that we ended up, well, let's act as if this were a new high day, that we were at 380 and we rallied to 393, 13 points. Then what I would be doing on February 19th is I would take the 393 strike that we're at right now. And generally what I do is I take 3 deviations from that. I'm going to come down to the 390s, okay? And I'm going to buy that 390 at $1.47. And so now, if I want to calculate in my head, let's say that the next day the stock drops $3 below 393. So I buy them today because we hit that high of 393. Monday we come in and we drop down to, let's say, 385. Well, there's tools out there available to tell you what that would mean to your profit. But I like to do it a little bit easier, and that is I would basically be $8 into the money. So I'm just going to move up $8. 1, 2, 3, 4, 5, 6, 7, 8. I'm going to move up $8 into the money right now from what I'm buying, and that's what these calls minus decay, okay, would be going for if the stock dropped down to 385. So that's just a really quick tool that you can do, is you can say, okay, let's say I'm buying a call today because I think the markets are going to go up. Well, here's the 393 calls out to February 19th. So if I buy a 395 call, it's $2 away, right? It's at 395. So that means I would go the opposite direction, $2. I would go 1, 2, okay? That's the price that it would be at if it moves up that amount. Does that make sense? I don't know if that makes sense, but that's just a quick way. You don't have to have all of the sophisticated, sometimes you don't have time to sit there and run calculations and everything, but that's how you can do it, is you can say that, look, if I'm buying in at 395 and the share price it moves $2 right now, then I can move down $2. And this is what the price would be, $2.55. My $1.59 would become $2.55. Okay, that's how that would move in premium. It would be really close, within 3 to 5% of that price is what it would be. So that's how I would kind of target. I would say, okay, I think that the market's going to rally and we're going to hit 396 or 397. well then, you know, if I'm buying a call at 395, I'm counting on it getting to 397. Okay. And so I'm going to go backwards 2 slots from my 395, and that's going to bring me 255 if I bought a February 19th. Okay. It's going to get me 255 if we rally up and hit that new high up there. So you can do that on all of your stocks, and it really helps. So if I take IMMR, because this is kind of how I did IMMR, okay, and I come over here and I say, okay, I'm going to enter IMMR, okay. Well, the 15s are running $1.95 to 250, the mid range of that today. Boom. Okay. 245, $2. So let's say 225. So now I've got to come back to IMMR. Okay. And I'm going to do the 20s. Okay. That's a $5 move that's happened. So if I take a $5 move, okay, off of the entry price, then okay. So if this happened to move to $20 Monday, this is what it would be priced at. I'm sorry, this is what it would be priced at. If it broke open and it made a move, then this is the price that it would be at. Okay. So that's just a quick reference way that you can, you know, start to build, you know, what your moves would look like if this happens. If I got a mid-range move, my 95 cents would be $1.45. So you can start thinking in those terms, and the faster that moves up, obviously, the further into this that you're going to get, the further you'll go into that. But it's just a quick reference is however far away you're buying, however many slots you go this way, go the opposite direction to, you know, I'm buying these, go the opposite direction back to the price point of where we're at, and that'll tell you what those would be at, okay, as we approach $20. Premiums like that. Nope. See, some of you have figured that out on your own. Good.
We're 4 over.
Yeah, we're 4 over. So I apologize. This has been a little bit scattered today. We've just got a lot going on, and without my material, it makes it a little bit different. But what I want to stress is that when you're looking at your options, is your entry points. You know, you make sure here's Momo, and I told you guys this is the China Joe stock. There's no reason in the world to sell it. Just let it go. I mean, if you're going to take any profit, it just closed this gap back here at 2069. Let's see, did it close it low? Yeah, 1968 was the low. So it just closed it. So there would be a natural reason for profit takers to be there. And that's the ones that were hanging in there, and they hung in all the way through this. And now there's going to start taking some profit because they just want their money back. And you'll have mentalities across that vein. That's why these pauses tend to happen on gap fills. So I wouldn't be surprised to see Momo go through a pause. Now, if the markets really rally and you've got this build happening right here in volume, this could just say, you know, the heck with that. We're going to just keep on cruising. And then the next gap is way up here at 30, just below 30. And I'll tell you guys, I'm telling you, it will fill this gap. Okay. China Joe, I told you guys that back here when the election happened, I told you this is your China Joe stock, it and QD. And so leaps would have been a great way to go. And I think some of you even went leaps, but here's the other China Joe stock. Okay. So I don't care your political affiliation. If this is going up, and these are 2 manipulated stocks by the CCP, and they are, and they use this money for themselves, by the way, but they thought they were going to need all of their money because of negotiations that were going that are now gone. And so here's this gap right here. You've got a gap down at the 420 level. So this is just going to look, I mean, there's just no resistance. There's just no resistance up until you get into this, which is where this, resistance and was happening. Support line, resistance line. It broke down. It's now gone through its cycle, and now it's heading upward. And so this is going to close this gap this year. It's going to be up here in the $758 range. So, I know everyone was ticked off at this stock because, it looked really promising when we were buying in here, and a lot of us stopped out. I kept some net free shares, but not a lot, and I took a big bath on them. But then once the election happened, I said, you want China Joe stock? Start really adding under there. We had this major volume day here, people thinking the same way, and it settled back down. So this is where we're going. So I wouldn't be, I would take hopefully a pullback day if we get one after this gap fill on Momo, but I wouldn't be afraid to go out here to within the administration that we would be in with leaps is look at these leap prices aren't that bad. So I would be looking at some of these leaps as a way to go on the Momo China Joe wagon right now, and simply because of I mean, you guys can read charts enough to see what's happening. The 200-day moving average has swooped in, and it's now taking a more natural 2150, 200. That's now going to become the norm. So yeah, it could settle in somewhere in here as these fall into place with a pullback. But you can either start with a position now or you can wait. But that and QD would be my top two leap trades for the year. And I would go out just as far as you can, like we did with AMC, because AMC was so darn cheap. We went crazy on those. So I would do the same thing with QD and Momo, because we are at the mercy right now of the CCP, and that's just the way it is. So that doesn't mean we don't get to make money while we're dealing with that. So I'll spend a lot more time on setups next time, because that's what I have in displays. I appreciate everyone's patience and time. Hopefully you picked up some things today, but I wish you happy trading, and we will see you with some more content as we go. Can we just do this every Friday? Oh, don't even talk to me. Not like this, we can't. Not scatterbrained. It's got to be, I'm a little bit more structured, and it's kind of upsetting me some, as I think you can tell. But at any rate, I hope you've gained some knowledge. We are not going to post this live.
Oh, you're going to post recording? Okay.
I need a full seminar.
Okay.
We need a lot more content. Okay, guys. Appreciate you guys, and we'll talk to you next time.
So stop sharing, and then scroll over.
Hey guys. Oh, are we off?
No, not yet. You ready?